Okay, I hope that this is working now. I don't know if it is. Let me know if it's working or not. Let's check in with this. See if I can hear myself. Check. I think that it is working now. So, apologies for the delay there. I'm sure that either my sister or Brian will tell me if the sound isn't working. Okay, so welcome everyone. Thank you for joining. Apologies for the little hiccup there. So let's get started. This is probably going to be like 45-ish minutes. I ran it earlier and it went a little over, so I'm going to try and go quicker. But thanks for joining. This is How Do You Buy a House in 2021? Because it seems like a lot of people are doing it, and I'm sure that you guys want to know how are they doing it. So I have broken it down into 3 key parts: time, money, expectations. These are the 3 things that you kind of want to take into account when you're going to be buying a place. How much time does it take? How much money do you need? And what should you expect from today's market? We're going to spend the most time in money, but we'll start with time. How much time do you need to commit to the whole process? Again, 3 parts. I split it up into 3 parts: the pre-search, your active search, and then your contract stage, once you're actually under contract with a house. These are all going to vary, but I'm going to give you just different breakdowns of the average of how they each, how long they each take. So we'll start with the pre-search. The pre-search is for the research. This is all the stuff that you want to get out of the way before you actually start looking at homes. First thing you want to do is discuss what you and your partner, if they're buying with you, want in a new home. And it's very important to separate your wants and your needs in this part. So you need, a certain number of bedrooms. You need 3 bedrooms. You need to be in a certain school district if your child is in a school district and you don't want to take them out of it. You need at least a 1,500 square foot house. Those are needs. Wants are more, I want a fireplace, a pool, a patio, things that you could live with if you didn't have them, but are ideal things that you would like to have. I would say look around on Zillow and Trulia. Don't request any showings or anything like that, but take a look around online and see what's out there, and it'll give you a good idea of what the market is currently offering. After you've decided what you want, you're going to want to start the search for a lender and get pre-approved. That is the first tangible step of something that you need to contact somebody to do. You're going to want to find a lender. I would not suggest going with anybody that you find online. I would definitely ask for referrals, either from your friends or your family, somebody that you have a connection with through someone else at least. Likely someone has bought a house, or a realtor who had a really good or bad experience with somebody, and they can give you recommendations on that. That's how you should go about that. And then talk to them. You can talk to a few different options, see who offers you the best rate. We'll go over loans later, but you want to see who offers you the best rate and go with them. And after that, you're going to find a realtor to help you out. Ideally, they have a lot of good reviews. They're roughly 6'5", maybe Italian, maybe their name is Tony, maybe their last name is Roberto. I think we see a common theme here. I'm not going to give you a whole spiel on myself. If you're watching this, you're a friend of mine. It's on Facebook. You know who I am. So next let me tell you the whole time for that. Full time for this, 1 to 3 weeks. You want to take a couple weeks, sit down, talk about what you really want, see what's out there, and get pre-approved. It can be sooner. You can take longer than that if you want. This is really your comfort level on how quickly you want to get started with all of this. So I would say about 1 to 3 weeks before you even start looking for a house. decide what you want and get yourself pre-approved and find a realtor to help you out. After that, you're pre-approved, you got a lender, you got a realtor. Now you start searching for a house. You know what you want. There are 4 major parts of the actual home search, and this is going to differ based on if you're in the New York tri-state area like we are, or if you're anywhere else in the country. We do it very different here. Here we do a search, then we make an offer on a house, then we get it accepted, then we have inspections, and then we sign contracts. Everywhere else in the country, when you make an offer on a house, you're offering them the contract, and then everything else happens after that. So here, I would say you're going to spend about 30 to 90 days looking for a house. It can be sooner than that. It can be longer than that. I've had some people where I brought them out once or twice. They found something and then they had an accepted offer and we went from there, and that was great. Inversely, I've had buyers that I've been working with for a year, 2 years, 3 years. It depends on how serious you are, if you're looking, and also how picky you are on what you want in a new home. If you're looking for something very, very specific, it may take longer because, there's not going to be that on the market. But I would say, in general, around a month or 2 is probably going to be the time it takes to search for a house and identify one that you like. You may identify multiple, and then you may put in offers on multiple, but in general, probably 30 to 90 days to identify a house, make an offer on it, and get it accepted. The offer stage, about 1 to 3 days. Typically, you'll hear back within a day or 2. It may be more if they have multiple offers and they're going to a highest and best kind of scenario, and they say, hey, give us your offers by Wednesday, and it's Sunday. It may be a couple days to hear back by then. But in general, 1 to 3 days, you should hear back from the offer that you submit to the sellers. If all goes well, you get the offer accepted, then you do inspections. Depending on how many inspections you have to do, it's going to be about a day to a week. And that's also depending on how backed up and how back scheduled the inspectors are. If you have to just do one home inspection, 3 days, 4 days, they usually have some time after that. If you have to do home and septic inspections, and then if you have to bring in a contractor to give you a quote, I would budget at least a week, maybe more, to get all those people to work with their schedule, to get them in the house. And then after that, after all of the inspections are done, everything is settled, you can renegotiate after the inspections, but we'll talk about that later. After everything is said and done after the inspections, you get the contracts drafted up. That's about 2 to 7 days for the attorneys to go back and forth between themselves, and also to bring you in to review the contracts and put your down payment down. In total, what you're looking at from when you decide that you've got your pre-approval, you know what you want, from when you start to look for a house to when you sign the contracts, roughly the 30 to 90 day period. Again, it'd be great if you find something right from the start, but likely the average is around 1 to 2 months to give yourself some time to look around. Then, when you do identify a place and you do sign contracts, the last part of the 3 parts that I mentioned is the actual contract process. Now, a lot of people ask me, what actually happens after I sign the contract? Well, the whole part of buying the house starts with your lender and with the attorneys. Another thing that we do in New York that and in parts of New Jersey and Connecticut that they don't do most other places in the country is we use attorneys. We use attorneys in most places, and most other parts of the country don't. The realtor handles the contracts and everything like that. Here, no, we make everything complicated. You hire attorneys, you pay them, it's an extra fee. But they handle everything from once the contracts are signed to closing in terms of the legal process of that. So what does this include? Your lender is going to start working on getting you your loan, which starts with ordering the appraisal. The appraisal will take anywhere from 7 to 35 days to actually get it back. It has to be ordered, it has to be scheduled, it has to be done, and then they have to write up the report and send it in. The appraisal is a person that the bank sends out to the house to look at it and appraise it and says, hey, it's worth this. I will talk about later in the little Q&A that I have at the end, what happens if the house doesn't appraise for the full value. It's a possibility, especially in this market. We'll talk about it later, but just to give you a timeline for this, it's between 7 and 35 days. Have I had it been before that? No. Have I had it go longer than that? Yeah, but that's usually because of COVID times and delays and everything like that. So getting the appraisal back to you from the day that contracts are signed, 7 to 35 days is what you're looking at. Title, you have to do a title search. What is that? You search the title. You have to order a title search to make sure that the title, the actual thing that you own the house with, has nothing bad on it. For example, if the sellers decided to hire a contractor to replace the roof, it cost $20,000 and they never paid the contractor. The contractor then could put a lien on the house for that $20,000 and the house could never sell until that lien was satisfied. So title search takes care of things like that. Make sure that it's all free and clear. You can expedite it and get it within about 2 weeks. Typically, it's between 2 weeks and a month. It could be a little more delayed if you're going to buy soon. COVID has delayed everything. Hopefully, that will open up things soon. But about 2 weeks to a month is really when you're going to get title back. Municipals is searching the town hall to make sure that everything about the property itself is legal. That addition that somebody put on the house, did they get a permit for that? Did they close out the permit? Did they have a certificate of occupancy? Does the central AC system that someone put in 3 years ago, does that have a permit? Because yes, you need permits for things like that. The municipal search is something that the attorney will do as well. Takes about 14 to 30 days. It can take more because of COVID. Typically, though, at a normal sale, 2 weeks to a month for both title and municipals. They usually come in around the same time. And both of them are municipals are delayed a lot more because of COVID and everything than title is, but that's the average. Mortgage commitment is what you get after appraisal comes in. It's all good, and after your lender goes through all your finances and makes sure everything is in check and you're all good. A mortgage commitment can have conditions. It can say, hey, this house doesn't have a CO, a certificate of occupancy for the addition that they put on, and this commitment is conditioned on the sellers getting that. Usually it's all right, but those are the kinds of things that they can be conditional on. To get your mortgage commitment, you're looking about 1 week, which is very quick, to about a month after you get the appraisal. So roughly quick. A month is definitely on the longer side of that, and a week is on the quicker side. It'll be somewhere in the middle. And then clear to close are the magic words that you always wait for when you're a buyer. And that is basically your lender saying, you're good. Your mortgage commitment is in. There's no conditions to clear. You are ready to schedule closing. Typically, as soon as you get the clear to close, you can start schedule closing, unless the sellers are working on some kind of repairs that are put into the contract, things like that. But in general, about 1 to 2 months from when you sign the contract, you'll be ready to close. Again, it can be a little longer than that. Is it going to be shorter than that? No. If we were anywhere else besides the tri-state area, yes, it would be shorter than that. But because we're in New York and because we make everything really difficult, it takes about a month and a half to close on a house once you've signed the contracts. So, money, that covers time. And if you want to, all of this together, the pre-search, the searching for a home, and the actual contract process, the time commitment on your end as a buyer, all in all, is probably a 4 to 6 month process if you're very serious. That is including you getting ready, getting pre-approved, searching, and going through the contract process. Can it be quicker? Sure, but on average, it's going to be around 4 to 6 months of when you decide I want to start the process to buy a house to when you're actually able to move in. 4 to 6 months, could be a little longer, could be a little shorter. Again, that's the average. So that's time. Let's talk about money. This is the main section of the whole presentation, and we're going to go over down payment, closing costs, and inspections. These are the 3 key things that you're going to be spending the most money on. Your down payment is not included in your closing costs. I'll say that now, and I'll say it later. A lot of times people think that closing costs include your down payment. It doesn't. They are 2 separate things, and inspections are also a little side thing that you do before the contract, but I thought it was important because they're not cheap. So let's go over down payment, and let's talk loan. There are a lot of loans that you can get, but there are 2 major ones that almost everybody always gets. They're conventional and FHA. I also included VA, which is for veterans. I included them together because they're both government-backed loans. Your down payment is going to vary based on, well, your current financial situation, how much you're comfortable with doing it, and the type of loan that you're going to be getting. So let's cover the differences between these 2 loans, talk a bit about them, and just talk about them. Conventional and FHA. We'll start with conventional. Conventional is a private loan from a private company. It has not very strict, but it has stricter than FHA standards for financial requirements to qualify for it. You typically have to have really good credit. You typically have to have good income and reserves in your bank account as well. Down payment can be as low as 3% of the purchase price, but the standard minimum is around 5%. I would suggest 5%. You can look at the 3% one, but the standard minimum is around 5%. And in a bit, we'll go over an example with an example purchase so you can see some actual tangible numbers. While it is more strict on the financial requirements to qualify, it is less strict on the condition of the house. I'll talk about it in a minute, but FHA is pretty strict on how the house has to be. Conventional, no upfront premium costs. So at closing, there are no premiums to pay for getting a conventional loan. You do have mortgage insurance that you will pay over the life of the loan until you hit 20% down. But no upfront costs for getting a conventional loan, which is a really nice thing. Both FHA and VA have that. They can offer really competitive rates and incentives if you have great credit. So if you've got credit that's in the high 700s or the 800s, conventional lenders are going to really offer you a great rate and probably some incentives as well. On the flip side, if your credit isn't as strong, they may offer worse rates than FHA. So FHA is great if your credit and your income and your financial situation isn't as strong, because if you try to go conventional, it's seen as more risky, so they're going to offer you a higher rate than FHA, which I'll get to in a second. And then another great thing about conventional loans, you pay mortgage insurance on every loan that you're going to get, but with a conventional loan, once you hit 20% down payment, it goes away forever. Now, if you start off with 20% down, great, you'll never have to pay it. If you start off with 10% down, once you do that extra 10 PMI, it goes away, it's done. Basically, once you get 80% of your, once you get 20% of your loan paid off and you have 80% left, the PMI goes away, and that's great. Conventional is strong if you've got great credit, good finances, and everything like that. FHA alternatively is great if your credit and your financial situation isn't as strong. It's a government-backed loan. It is much easier to qualify for if your credit and your financial situation isn't super hot, and it is actually very competitive. Even with conventional being awesome, there's usually a breaking point to which FHA is actually a better option Again, you can probably get an FHA loan with as low as, I think, a 580 credit score, but it's usually around the low 600s that they really want to see for FHA loans. The down payment can be as low as 3.5%, and the VA loan for veterans specifically can be as low as 0% down. But both of these, the VA loan and the FHA loan, have high insurance premiums that you have to pay at closing and over the course of the loan that never go away. FHA one can, but I'll get to that in the next slide. Yeah, so both of these have premiums that you have to pay at closing, and they're not cheap. They're a couple $1,000s depending on how much of a loan you're getting, and then over the course of the entire loan, you have a premium that you have to pay unless you put 10% down, and I'll go to that in a second. They also both have very strict guidelines that a house has to meet. So because it's a government-backed loan and it is a little more risky, the house itself has to be in good condition. Now, I'm not saying that the kitchen has to be beautifully updated and the bathroom has to have subway tiles. No, just structurally, it has to be in a very good condition. And it also has some weird rules. Like, for example, if the house is on a well and a septic system, opposed to being on municipal water and sewer, where you get your water and your sewer from the city, if instead it's on a well and a septic, the well and the septic tank have to be at least 100 feet apart. If they're not, then you can't get the loan with an FHA or VA deal. Condos, not all condos are FHA approved. In fact, a lot of them aren't. So if you're looking to get a condo, you're going to have to go conventional unless it's specifically FHA approved. And there's a whole list online of condos that are approved if you want to look at them. But in general, FHA, better for lower credit, better for not great financial situations, but you get penalized for that by paying higher premiums. And sometimes they don't offer as great rates as conventional. Both of these have loan limits and mortgage insurance, as I just mentioned. So conventional has PMI, FHA has MIP. Don't know why they didn't just call them the same thing, but I didn't make that decision. So PMI on a conventional loan is going to range from 0.5% to 1.85% of the yearly loan amount. And that goes away once you hit 20%. It goes away forever. You never have to pay it again. That range is probably going to depend on your credit and your financial situation, everything like that. So again, the better the credit and everything that you've got, the more incentives they're going to offer you. The MIP for FHA loans, about 0.45% to 1.05%, and that never goes away unless you put down at least 10% when you're buying the house. Then it goes away after 11 years. So you have to pay it for 11 years no matter what. If you do less than 10% down on an FHA loan, you're going to be paying it forever. So that's the only way to get it off the loan after 11 years if you put 10% down. And this is a lot of information, I know, so if anybody wants a copy of this little presentation that I made, just let me know. I will send it to you. And again, FHA and VA loans have upfront fees that you have to pay at closing for using them. FHA has a 1.75% of your loan fee, and the VA has a funding fee that ranges from 1.4% to 3.6%. Both of these you pay at closing. We can talk about putting your closing costs into your mortgage later, but they're non-negotiable. You gotta pay them, and they're not cheap. Again, 1.75% doesn't seem like a big percent, but on a loan that's $300,000, that's almost $4,000 that you have to pay. And the same thing for VA. The VA funding fee is going to depend on if it's your first time getting a VA loan or if it's a repeat, and how much you're putting down. The less you put down, the higher the fee. And then loan limits, conventional flat loan limit of $822 across the United States. Anything that's higher than that is a jumbo loan. And FHA have loan limits that change by state and county. So since we're in the Hudson Valley, these are our loan limits. Basically, Westchester, Putnam, and Rockland are all the same. They're the highest that you can go, and Dutchess and Orange are the lower end. Yeah, these are loan limits. You can't get a FHA loan for higher than this amount. So if you're buying a $400,000 house in Dutchess, you need to have the extra money to cover that down payment to get you to 356. So which loan type is right for you? You should definitely talk to your lender about it. I can't tell you which is best, but my general thought process is if you have great, like amazing credit, even if you have really good credit, and you've got a lot of money saved up, you've got a good financial situation, go conventional, they're probably going to offer you a better rate. If your financial situation could improve, could use some work, you don't have the best credit in the world, go FHA. They still offer really, really good rates. It's just conventional is going to reward you if you've got that really, really good situation. So talk to your lender, get quotes for both of them, see which rate both loans are going to offer you and what mortgage insurance they're going to charge you for each, and go with the better one. That's what it comes down to. Whoever offers you the best rate is the right loan type for you. So yeah, some little additional information on some loans. Your down payment can be gifted to you. It's an important part of the whole process. A lot, and almost 100% of the first-time home buyers that I help get a gift from their family members or their friends, or it can be your employer, which will never happen, but it's possible. If your family member or your friend or your employer wants to gift you the money for a down payment, they can, and that's allowed, and it's not a big deal. The only caveat is if someone's giving you under 20% of a down payment, so if they're only gifting you 15% down payment, you have to provide at least 5% yourself. If they're giving you over 20%, nothing to worry about. But if it's under that, then you've got to at least shell out 5% of the down payment yourself. I covered this one. The only way to get rid of the mortgage insurance on an FHA loan is if you pay 10% or more as a down payment. Then it goes away after 11 years. Things your lenders are going to need. So this is part of the part of everything that you want to get ready. Last 30 days of pay stubs, 2 years of your W-2s or 1099s, and probably recent bank statements as well. They're going to continuously need your pay stubs and your bank statements throughout the entire process once you sign contracts to make sure nothing shady is happening. So keep those handy, get those ready for when you want to get your pre-approval. If you start a new job, shouldn't be a big deal as long as it's a W-2 job. You'll have to wait 30 days for pay stubs. But if you're starting a new self-employed job where you get a 1099, it can be a bit more of an issue. So you'll want to talk to your lender about that, because with a 1099, there's no guarantee to know how much you're going to make. With a W-2, you get a flat payment every week or every 2 weeks, or however many times you get paid per month. Self-employed, it's not the same story. So you're going to have to talk to your lender. You try not to change jobs, especially if you have already started the process. Try not to change your jobs if possible. The amount that you can afford is going to depend on your credit, your income, your debt to income ratio, and the interest rate that you're being offered. That's going to depend on the actual amount that you can get qualified for. So debt to income ratio is a big one that I haven't really talked about. If you want to find it out, take all of the debt that you have and all of the income that you have and combine it and find what the percentage of the debt is to your income. So if you make $100 a month and $50 of that you have to pay to student loans and car loans and things like that, that's a 50% debt to income ratio, which is very high. If you have over 50% of DTI, you probably will not be able to qualify for a loan. I suggest paying down as much debt that you can before searching for a home. I know a lot of us have student loan debt, so that often is a really big hindrance in the amount. It's not going to always stop you from getting approved for a loan, but it may reduce the amount that you're able to be qualified for. After that, while you can do a 0% down on a VA loan, sellers are typically still going to want some kind of earnest money that they can give back at closing. The money that you put down is insurance for the seller to make sure that you're not just going to walk away if you decide that you don't like the house. So like you can do 0% down. I did one last year. It was a 0% down VA loan, but they put $3,000 down at contract signing, but they got that money back at closing. But it was, if you put nothing down at contract and for some reason you just decide to leave, if you have no money down, they have nothing to take from you basically. So it's some kind of insurance for the sellers. So yeah, that covers loans. Again, a lot of information. If you want a copy of this afterwards, or this is recorded, feel free to go through it. But that should give you an overview of the loans and down payment. After this slide, we'll go through an example so I can give you some actual numbers to work with for buying a house. Closing costs are on top of the down payment. These are not included with your down payment. These are something that you pay at closing to lots of different places. And so all of these are the major things that make up your closing costs. Let's go through them. Title search. We talked about this earlier. They search the title to make sure everything about the title, there's no liens, there's no encumbrances, there's nobody else that has a claim to the title. They're going to search it and you pay them for it. Prepaid taxes. Your lender will typically have you prepay some taxes at closing to put in a reserve account. I don't know why they do it. I know there's a reason. I've never asked. They just do it. I've seen it be anywhere from 2 months. I've seen them do it for an entire year. It's probably going to depend on your credit, your income, all of that fun stuff. So keep that in mind. That's going to be a really big part of your closing costs, because taxes in New York are not cheap. Mortgage tax. Every county is different, but every county is going to tax you on having a mortgage, and it's usually, I think in Westchester and Putnam, I think it is 1.3% of whatever the loan is. So that's a fun tax to pay. Loan insurance. This is what I was talking about with FHA and VA loans. Those are upfront costs that you will pay. If you have conventional, you don't have to worry about it. There is a little bit of insurance that you have to pay from the day that you close to the day that you make your first mortgage payment. They still want their insurance for that period, so you pay them a small cost for that. Prorated fees. Proration is paying the sellers back for something that they've already paid for, which is taxes and sometimes utilities. So if, for example, the tax year started on January 1st and you're moving in June, halfway through the year, let's say taxes were $12,000 for the year, $1,000 a month, you need to pay the sellers back $6,000 because they already paid the whole year in full, and they're not going to be living there after you move in, so you got to pay them back. That's what prorated fees are. And so you got to pay the sellers back. If they have an oil tank, you have to pay them for how much oil is in the tank, things like that. Loan fees, that is what your lender is going to charge you for actually getting the loan. Municipal search, talked about that, actually searching for making sure everything about the property is legal. Attorney fees, very simple, you got to pay an attorney. And title insurance. Title insurance, you pay one time. They're going to tell you that it is optional. Please pay for it. I had one person say that they weren't going to do it, and you need to do it. You're never going to need it, most likely. That's the thing about insurance. You hope that you never need it, and that's why you pay for it. It's a one-time fee. It's not the cheapest thing in the world, but it will protect you in the future in case the title search missed something. So I always give the example, if if you're buying like an estate or something, and one of the kids was not included in the sale, and somehow they have a stake and claim to the property, and then it turns out that they own the property, your title insurance can give you a settlement payment for that if you lose the property through something like that. That is an extreme hypothetical that will never happen to you, but should something like that happen and you don't have title insurance, you're going to be very upset. So yeah. Oh, that was a lot. I know it's a lot. We'll go over an example. Let's assume we're buying a house worth $300,000, and let's assume you're putting 5% down. Let's go over the exact cost that this situation would cost you. $300,000 is an average for the Dutchess area where I live. Putnam is a little higher. Westchester is even higher. But let's assume $300,000, you're putting 5% down. So, and we're also going to assume up here, yearly taxes, we're going to assume $8,000, which is pretty low. So just keep that in mind. These fees up here are separate. You still have to pay them, but they are not included in your closing costs. The down payment, which is 5% of $300,000, is $15,000. The home inspections are going to run anywhere between $500 and $1,500, depending on how many inspections you do. If you have to just do one home inspection and the home isn't huge, probably going to be between $500 and $700. If you have to do a home inspection, a water inspection, a septic inspection, a radon inspection, you're probably going to break the $1,000 mark. It's worth it because you want to know that the house is in good condition, and you can also use these things to negotiate with the seller if things aren't as you want them. We'll talk about that in the expectations, but you have to pay it. It's peace of mind, and it's 100% worth it. The appraisal you can include in your closing costs, but you typically will pay that out of pocket during the contract process. It's usually between $300 and $700. Sometimes it's more, it depends on your lender, but it's usually around this cost. Now, on top of this already $16,000 that you have to pay, your closing costs include all of the things that I mentioned up above. Loan origination and your loan fees. This is what the lender charges you for getting a loan. Again, all of these things that I have listed here are general topics. Each of these have subtopics that they have small charges for. This is just the general topic of each of these. So loan origination, what they're going to charge you to get the loan, between $2,000 and $3,000, usually between 0.8% and 1% of the actual loan itself. Here, it's a purchase price of $300,000, but the actual loan is $285,000 because you're putting 5% down. This number will go up or down depending on the purchase price, but with our example of $300,000, this is likely what it's going to cost for your loan fees. Could be lower, could be higher. This is the average. Title insurance. Again, this is the insurance, the one-time fee that you pay to insure yourself for the entire life that you're living in the house, is usually around 0.5% of a loan. For this, $1,200 to $2,000. $2,000 is definitely on the higher end, even for this purchase price, so you're not really going to get to that most likely. It'll probably be around the $1,200 mark, maybe lower. Title search and title fees. Title search itself is usually around $800, but there's a whole litany of other fees that you have to pay to title. And title isn't cheap. It's not a cheap thing. It's around $2,000 to $3,500 at this price point. If you're going at a higher price point, it might be more. But at this price point, $2,000, $3,500. Attorneys, you pay anywhere between $1,500 to $2,000. The one that I use quite a lot charges $2,100. I also have others that charge between 1,600 and 1,700 and 1,800 who are equally as amazing. So you're going to be somewhere in the $1,500 to $2,000 range. You typically will pay them a small retainer at the start of the process of a few $100s, and then you pay the rest of it at closing, and you don't pay them if you don't close, because then, what's the point? So typically you'll pay them about $300, $400 up front, and then the remainder at closing. The tax reserves, this is going to be the biggest variable in all of these closing costs, and that's going to depend on how much your lender puts into reserves. For here, I put 2 to 6 months, I think. So it's going to be somewhere in there. Again, I've seen them use an entire year. It's going to depend on what your lender does, but you have to put some of the taxes into a reserve account. They always want to make sure that the taxes will be paid. Homeowners insurance, you pay 1 year in advance at closing, and then you just pay it monthly after that. It's between $1,000 and $1,500, and that won't adjust too much, I think, based on the purchase price. It's usually always going to be around that price. And then this upfront mortgage insurance you pay if you've got an FHA or VA loan. So for the example that we are using, if you got an FHA loan for a $300,000 house, you would pay almost $5,000 as an upfront insurance fee. If you got a VA loan with 5% down and it's your first time, you're going to spend $4,700. You do not pay any of these if you're getting a conventional loan. This does not apply. So this is where it's nice to have a conventional loan, and part of where you get rewarded for having good credit and a financial situation, because it kind of stinks to pay these, but you have to if you have an FHA or VA loan. And then your mortgage tax, I think I used Westchester or Putnam as the example for this purchase, and it's, if I remember correctly, 1.3% of the actual loan is taxed, and so that's what you're paying. So your total closing costs for a purchase price of around $300,000 is going to be anywhere between $13,000 and $20,000. The $20,000 is definitely on the high end, so just keep that in mind. That is way towards the higher budget everything, and that's between 4.4 and 6.5%. Somewhere in the middle of 2 to 7% is generally where they are. You're going to be in New York. You're going to be probably closer to the 4 to 5% just because of taxes. They are very, very expensive here, but can't do anything about it. This, again, 13 to 20 does not include these fees up here on the top right of the down payment, the inspection, and the appraisal. So if we add all of these together, you got $15,000 for this. Let's say you have to do, a home inspection and a septic inspection. That's about $1,000. Let's say you have to do the appraisal. You're looking at $16,000-ish or more here, plus another $15,000. You're looking for a purchase price of $300,000 in total, out-of-pocket fees around $30,000 to $35,000, and that's on the lower end. It can be a little lower if you go with FHA and you have a lower down payment, but then you're going to be paying a mortgage insurance fee, and so that kind of negates it. So in general, even if you do around 5% down, budget another 5% for your closing costs. It's always best to overestimate than to under, and you don't want to just have enough in your bank. You want to have some after. You don't want to be house poor once you move in. You want to be able to buy furniture. You want to be able to buy the things that you like once you move in. You need to be able to buy food. So you want to have a bit of a buffer as well. And for a purchase price of $300,000, you need to have around $30,000 to $35,000 in the bank, plus reserves afterwards. to help you out. Now, again, these fees can be gifted to you by family, by friends, by your employer, by a random guy on the street. They just can't be an interested party in the transaction. Like if I was your realtor, I could not gift you these fees. Hey, I don't have the money to gift you these fees, but I wouldn't be able to. So these fees, again, can be gifted, and we'll talk about putting the closing costs into the mortgage. But the down payment, you can't put the down payment into your mortgage. You have to pay it. The home inspection, you have to pay, and the appraisal, you have to pay. So again, this is roughly the cost of closing costs. This is roughly the cost of what it's going to take to purchase a house for $300,000. Budget around 30 to 35, and have some money afterwards. If you want to increase your down payment, that number is going to be higher. So keep that in mind as well. I typically always suggest if you can do 20% down, do 20% down. It will strengthen your offer, and it will also eliminate PMI, which is usually PMI. The insurance is usually going to be around a couple $100 a month, and that adds up over time. So especially for around $300,000, you're looking at a couple $100 a month just for mortgage insurance. It'll probably be on the lower end at this price point, but it adds up over time. So if you can do 20% down, I say go for it. If you can't, hey, you can't. So that's money. Let's talk about expectations. We are almost done. This is the last part. And basically what to expect, I'm just going to talk about common questions that I get from first-time homebuyers, people who are thinking about buying. And those are, what is the market like right now as a buyer? I'm sure you know to an extent what it's like. It's a little crazy. There are not nearly enough houses for sale, and there are a lot of buyers. So a lot of times it will homes will go into bidding wars, and they'll go for over asking price. I would expect to not get the first one or two houses that you put offers in on, because they may go for very, very high above the asking price, and sometimes a cash buyer might waltz in and just make an offer, and if you have a mortgage, your chances are severely diminished because cash is king, and if someone offers a cash offer, then the sellers pretty much always take it because they don't have to worry about appraisal. They don't have to worry about a bunch of things they have to worry about when you're getting a loan. So it's crazy right now, which leads me into the next question. Should I wait for the market to crash? When is the right time to buy? My opinion, which is just an opinion, and it can be wrong because opinions are wrong all the time, but my opinion is that the market isn't going to crash. Every time that the market has crashed, it's because the money wasn't there. And even in 2008, when it crashed, that was because banks were giving out really bad loans to people who really shouldn't have been able to qualify for loans. Right now, banks are pretty strict about getting a loan. Someone who was able to qualify in 2007 to get a loan, a subprime mortgage, as they call them, probably would not be able to get qualified in today's market. So banks are being pretty careful, and the thing is, the money is still there. People have the money to buy these houses. So I don't think that the market is going to crash. My opinion is that it's going to stabilize in the very soon coming months. I believe that more people will put their houses on the market, and that should help saturate the market and make it a little easier for everybody. When is the right time to buy? When you're ready. You can make the argument that spring and summer is the best. You can make the argument that fall and winter is the best. It really is when you're looking and when you're comfortable. Spring and summer, yes, that is when the most houses are on the market. That's when everybody lists their house. Inversely, that is when you're going to have the most competition as a buyer because everybody's looking for homes during the spring and summer. During the fall and winter, there are less homes that are on the market. But if someone's selling their house in winter, you know they're serious. And there are a lot less buyers out during winter and during fall. So you could make the argument that it's easier during winter and during fall because there's less competition. It really comes down to when you're comfortable with. There is no right time to buy, especially if you're looking to purchase a home that you're going to be in for a couple years, 5, 6, 7, 8 years. Waiting for the right time isn't necessarily something that would make sense. It really comes down to what you're comfortable with. Are rising home prices bad for buyers right now? Yes and no. I mean, I've seen certain listings go for $50,000, $60,000, $70,000, $80,000 above what the purchase price is. Most of them do not go that high, but some of them do. The only saving grace, and I say this about once a day to someone who asks me, the only saving grace about this market right now is that interest rates are historically low. And I'm not exaggerating, they are hitting historic lows. And even if prices were to go down in the future, if interest rates were to go up, that's what kills you in the long run because you pay interest every single year on the loan that you get. And that's not mortgage insurance, that is your interest rate that you get for the loan that you pay every year, which is interest. So that's the only saving grace about this market right now, is that even though prices are rising, the rates that you get for a mortgage really kind of even it out. Because if prices are up and interest rates are low, you pay a certain amount. If interest rates go up and prices go down, it kind of evens out a bit. So it is bad for the ones that are going $50,000, $60,000, $70,000, $80,000 above the asking price. Yeah, that's not necessarily the best situation. But I have a buyer who is getting a 2.75% interest rate. That's crazy low. I've never seen anything like that. So that's a really, really good thing to look forward to as a buyer right now. In the future, a year or 2 years from now, they're definitely going to be a lot higher. And the interest is what kills you in the long run. What shouldn't you do before buying a house? Anything major with your credit card, anything major with your credit, don't deposit any large amounts into your bank account, anything that may seem a little fishy to a lender, do not do. Don't buy a new car, don't lease a new car, don't open a new credit card account, don't close one. You want to keep things as consistent as possible, because if you have like a $50,000 deposit into your bank account and then a week later you go and apply for a loan, they're going to be like, where did that come from? And it'll be troublesome. I had one client open a Home Depot credit card a week before closing, and it almost derailed the entire thing. So you really want to keep things consistent as possible with your financial situation before buying a house, and especially during the process. Don't do anything crazy during the process. Do you need a realtor to buy a house? I'm biased, but yes. A buyer's agent, you don't pay. You don't pay a buyer's agent. You don't pay them out of pocket. The way a buyer's agent gets paid is through the seller's proceeds at closing. When a seller lists a house for sale, they say, I'm paying this percentage, and the seller's agent, the listing agent, says, okay, I'm taking this percent and I'm splitting this percent with the buyer agent, and at closing they get split. So there's no out of pocket cost for paying for using a realtor to help you buy a house, and you get somebody that is experienced that helps you throughout the entire process, that you can call or text or email with all of your questions through the whole thing. it's 100% worth it. And yes, I'm biased. It's what I do for a job, but after going through it with so many people, if you had to go in blind by yourself, you probably would not have the best experience. So my opinion is yes. Can you put your closing costs into the mortgage? You can. I wouldn't suggest it in this market because it will weaken your offer. And if you're competing with even one or two other people, unless you have a really high offer, it's going to weaken your offer, because not only does the house then have to appraise for the full value of what you're buying it, the house also has to appraise for that value plus the closing costs that you're going to put into the mortgage, which can be difficult, especially if you're already paying over the asking price. So you can do it, and if it were a buyer's market, I would definitely say, yeah, 100%. What I would say is, if you're looking to do that, don't make the sale contingent on it. Wait for, proceed as normal throughout the sale. And then if your appraisal comes in higher than what you have actually got as a loan, then you can put some of the costs in there, because the bank is telling you, hey, we'll give you a loan up to this amount, and you're only getting a loan for this amount. You got extra in here that you can put closing costs into. Typically, an appraisal will come in at loan value. So there usually isn't a whole ton of extra room. But yes, in a general sense, you can put your closing costs into your mortgage. In this market, I wouldn't suggest it as a buyer, just because it will weaken your offer. That's just my opinion. But you can try. What happens if the home inspection goes terrible? Well, you can either negotiate with the seller to try and fix a bunch of issues that came up. You can walk away from the deal, or they fix everything. Typically, after a home inspection, you will get a huge report that is 70, 80, 90 pages long, and at the end there will be a summary. And you ask for things for them to take care of or give you credits for issues that are large. If, for example, an outlet doesn't work, you don't ask them for something like that. If the whole house doesn't have power, yeah, and you're expecting it to have power, yeah, that's something that you should address. So an offer is not binding by any means. So if you do the inspection and you hate it, you can just walk away. And especially if you do the home inspection, there's a lot of things wrong with it, and you're really not feeling comfortable, and the seller is not taking care of anything, then you have to talk about, is it worth it? And then what can I ask the seller to address after the inspection? Again, major things. If there's a foundation issue, if the whole entire roof needs to be replaced, if there's mold in the attic, there's always mold in the attic. There is almost always mold in the attic. They are breeding grounds for mold, because hot air rises and it meets with the cold air outside, and it condenses and it grows mold. It is not the worst thing in the world if you have mold in the attic. I'm just telling you right now, it can be remediated, and there are things that you can do to prevent it. But that is something that you can tell the sellers, hey, we'll continue, but we want you to take care of this, or we want a credit to do it ourselves. Big things like that are what you ask the seller to take care of. And then what happens if the house doesn't appraise for the full value? 3 things can happen. First is the deal falls apart. Second is the seller can force you to bring they can't force you. They can ask you to bring the rest of the difference to closing in cash. So if you're getting a loan for $100,000 and it only appraises for $90,000, the seller can say, bring $10,000 to the closing. I want $100,000, or nothing's going on. So they can say that, and you can agree or disagree, or you can meet in the middle. You can say, no, I'll bring $5,000. All right, I'm not bringing 10. I'll bring 5. Or the seller can just eat the full cost. So that's 4 options. You eat the cost as the buyer and you bring the rest to closing. The seller eats the cost and you get a lower loan. You guys meet in the middle, or if none of that works, the deal falls apart. Those are the main things that happen if it doesn't appraise for full value. Some buyers are putting in appraisal protection for the sellers in their offers. It is something that I'm doing in a lot of my offers right now, where we make an offer and we say either we'll guarantee you, X purchase price at closing. Even if it underappraises, we'll make sure you get this price at closing. Or they say, we'll guarantee you $10,000 above the appraised price if it underappraises, as long as it doesn't go above the actual purchase price itself. So those are things you can do to strengthen your offer, especially when you're in a multiple offer situation. That's it. That was a lot. I know it was a lot. I'm sorry. I hope it wasn't too much. If you have any questions, please type them in the chat. I think that I can see them. I have it pulled up on my phone. So if you have any questions, by all means, please write them in the chat. There is about a 30-second delay. So I'm going to sit here and wait for some questions. And it's going to seem like a lot longer because there's a delay. But if you type a question in the chat, I will read it. But I think I covered most of the questions that you should have about buying a house. We covered time, we covered money, and we covered what to expect. Just to go over the general parts: time, before you start to look, get pre-approved, find out what you want, find a realtor. When you're looking around, see as many homes as you can, block out your weekends, go to as many open houses as you can. You want to get an idea for what the market offers you. And then all of that combined with contract, you're looking at like almost a half a year commitment from when you decide I need to start thinking about buying a house to when you actually do. 4 to 6 months is your time frame. Then money, depending on how much you put down, that's going to change. Minimum is either 5% or 3.5% for the loans that we discussed. And then closing costs, between 2 to 7% of what the final sale price is. In New York, budget for the 5% mark because taxes are high. And then expectations as a buyer, it's going to be very tough, but the only saving grace is that, their interest rates are crazy low. So, yeah, that's all I got. I'm going to check this to see if anybody has written anything. I don't know. Oh, I don't see these in here. So there are comments that I had no idea that are over here. Yes, the video can be rewatched. At what point should you get home insurance? During the contract process is when you look at home insurance, and you'll pay home insurance during closing. You'll pay home insurance a full year in advance typically, you'll typically pay them a whole year in advance. So you'll look for home insurance during the contract process, probably towards the later part of that. You'll pay them a whole fee at closing, and then that's part of your mortgage payment after that. Kevin, when looking for a lender, doing a credit pull, what is the period of time between? That I would ask a lender, but I think and I could be wrong, I think it's better to have multiple inquiries at one time than to space them out, because if I remember correctly, your credit report, if it sees multiple inquiries at once, it will know that you're shopping around for something, and it shouldn't give you that much of a problem. So they shouldn't all need to do a hard credit check to give you a pre-qualification. They should be able to give you rates and things like that. And if you know your credit score, you may be able to say, hey, here's my credit report, take a look at it. But try not to space it out. Try not to have them do it every couple months. Your pre-approval is going to last you a couple months before it expires. And even if it does expire, unless it's like a year old, you don't need to get a new pre-approval that updated every 3-4 months. So you should be all right. But try not to space it out to get multiple credit checks, every couple of months, because then that's going to bring down your credit. Let's see. I think that's all the questions. I'm sure I'm still answering them in the actual live version, but I'll give it another minute if anyone else wants to ask some more questions. Oh, now I see the comments. For some reason, I didn't see them on my phone, so I can go back to here so you guys don't have to look at the back office kind of stuff. Yeah, no one's writing any more new questions, so I think we could go ahead and end it. But Felicia wrote some insight onto the insurance. She's an insurance agent, so thank you, Felicia, for that. Yeah, I'm not seeing a bunch of new questions, so I'm going to end the live. Thank you guys so much for coming. I can do more of these if you want. I can cover different topics. I can go more in depth of loan types. I can do one about short sales and foreclosures and REO properties. I can do a whole bunch of these. So this is more of a general one, but if you want me to do more, then just let me know. And if you have questions about specific types of things, we're on Facebook. Reach out to me. I am happy to help.